critical ingredient for innovation to succeed. On this slide, you will see three main elements that support trust. The first is legal certainty, and I'll talk about that at the beginning. People need to understand that these legal constructs are stable and will be actually enforceable. So if you buy something and you want to enforce your rights, you need to be able to do that. So classically, you want to be able to redeem the token for the underlying asset. I'll talk more about how Binance has done this for some of our equity offerings globally on a tokenized model. Now, secondly, effective risk governance. So the product has to be designed, rolled out, and distributed in a way that manages risks for consumers. And thirdly, participants need to understand that it's market integrity and that these are not barriers to innovation, but actually they are foundations on how innovation can grow. So regardless of technology, the objective should be the same. Build trusted market infrastructure using trusted brand names that have been there for a long haul, and encourage responsible innovation by these market participants while giving customers the tools, the knowledge, and experience they need to make those financial determinations for themselves in a way that's safe and which takes into account their own personal financial standing and position. Now, once these ingredients are in place, we can move into actually the real-world adoption phase. And that's exactly what we're seeing in global markets today. Just a few years ago, tokenization was discussed as a future possibility. I remember attending conventions like this a couple of years ago. And the theme of those conventions was, is crypto a legitimate thing? Is it the next big scam? Fast forward to today, we're actually talking about real-world adoption, measurable adoption of something as advanced and as complicated as real-world asset tokenization. Now, if you look at the chart on that, that's a McKinsey report from 2024, which predicts on a base assumption, not even a bull market assumption, a base assumption that we could hit $2 trillion by 2030. And more optimistic suggestions are almost double of that. Now, you'll notice that the largest opportunities are in cash and deposits, mutual funds and ETFs, securitized assets and alternative funds. It is not a coincidence that about a decade into digital asset technology, we used to call that DLTs, right? Digital ledger technologies. We're still talking about financial instruments, largely financial instruments that are the subject of real-world asset tokenization. And the reason for that is this is actually the simplest way to experiment on and encourage large-scale adoption of tokenized assets. We saw some of the presentations that they talk about IP and land. Those are arguably more complicated areas to actually tokenize. And I think a lot of the learnings from financial services, core financial products, will become the foundation for us to be able to move tokenization to other categories of asset classes, including supply chain, IP, and so on and so forth. As I mentioned before, tokenization is not a process of creating a new asset class. There's this misconception sometimes that we are creating entirely new asset classes. We're not. We're mainly making existing asset classes more accessible, more liquid, with less barrier to entry, and less barrier for transferability of rights of those assets. Now, the key takeaway is that we've entered a whole new phase. If you look at the chart on the right-hand side, you can see that there's about 34 billion in tokenized real-world assets. Let me talk to you for a moment about Binance's experience. We have at the moment about 320 to 330 million customers worldwide. There are about 700 million crypto asset holding customers globally on a consumer basis. That number is already larger than the number of people who own stock brokerage accounts globally. So the shift from traditional finance and traditional fund markets to a tokenized version or digital asset version of life has already gone past the point of equality, right? So there's much more digital asset holding customers compared to traditional fund holding customers globally at this point, and we're barely scratching the surface. Now, this naturally leads to the next question. Let's assume for a moment that we can run this marketplace responsibly, we can scale this while minimizing risk to consumers. The question is, why are so many institutions and market participants investing in tokenization in the first place? What are the pain points they're trying to avoid, and what practical benefits does it actually give you? As I mentioned earlier on when I was in the panel, understanding the demand side of the equation is going to be critical in terms of designing the next wave of products, because without intelligent design, we're not going to have adoption. A lot of these themes are talked about today, so I'll keep this very light. Firstly, fractional access. On the Binance platform, you can now access US equities for as little as $5 in terms of the minimum buy. And if you try to do the same with most traditional brokerages, you're going to run into multiple friction points. Firstly, the number of intermediaries you need to get through. You probably need a brokerage account first, and the brokerage account will be limited in terms of the exposure it gives you to the US equities market in general. On top of that, the minimum spend you have to make, or the minimum amount of shares you can buy, there'll also be a base limit or a floor, which means that these asset classes are most of the time priced out for a large number of retail investors. What tokenization does is it allows you to break that minimum size of a share into smaller and smaller units, which means that there can be more and more fractional access to what is typically known as the base stock size. So that's the first, which means your entry point for investing becomes much lower. We heard in this team talk earlier that one of the things we want to control for in Vietnam is actually consumer risk for the domestic market, and to make sure that people do not invest beyond their capabilities. Or fractionalization allows people to invest up to the limit of their capabilities. Secondly, broader market access. Tokenization allows global products to be made available to a user base in country X. And it allows this access to happen through a singular platform. The race for the future is not merely on a single asset class. The race for the future is on which platform can give users the maximum number of products in a safe, in a stable, and scalable platform as possible, without having to switch between app environments or site environments, website environments. So users want a one-size-fits-all, one platform that offers all products to them. And so broader market access becomes then much more accessible through a tokenization model. Improved liquidity potential. This has been talked about a lot before, so I won't go into that. Transparency and auditability. One of the beauties of having on-chain transactions is the fact that these ledgers of wallet addresses and the movement of assets between wallet addresses are publicly auditable. And so, unlike a traditional financial services model where you are reconciling between the ledgers of multiple different financial institutions, on a blockchain model, that is simply not necessary. And the record is there permanently immutable for all to be able to track it. So the value isn't technology itself. The value is, what does it actually enable? Apart from improving liquidity and making assets easier to transfer and fractional ownership, which lowers the investment barrier, it actually then connects issuers and users directly through digital infrastructure. So the Tether team earlier talked about how they provide the infrastructure, and then based on the infrastructure, you have market makers, you have issuers, you have legal structuring, advisors working together. All that is invisible to the user. What the user sees is a single platform that offers them a universe of investment opportunities at an affordable cost in a way they can intuitively understand, and a dashboard they can see every day and be able to see their assets under management on a daily basis. And should they want to get access to the underlying assets, they can do that with a click of a button within the app environment itself, because there's one-for-one redemption of the underlying asset. So for example, when Binance offers US equities, it is actually redeemable one-for-one for the underlying equity without delay, instantaneously. So when we talk about tokenization, we're talking about building a much more efficient financial system, one that is future-focused and actually one that is much more attuned to the preferences of the users. That's what I meant by the demographic shift. It's what the digitally savvy generation actually wants. And it's more about making that efficient rather than replacing the existing financial system entirely. So far we've talked about the supply economics. Now the figures on this slide highlight a significant gap in today's financial system. Only about 11%, as I mentioned, of global users have a brokerage account through which to invest into equities market or even the debt market, the bond market. According to Binance research, the vast majority of people in this world still only have limited access to traditional investment markets. At the same time, when we launched stock trading on Binance, we surpassed $1 billion USD in assets under management within the first 30 days. When we launched tokenized versions of gold and silver, as well as tokenized versions of pre-IPO stocks such as SpaceX, those became the most invested into categories of investments within days of their launch. This is just one product, but it reflects a much broader structural trend that users are looking for much more accessible and efficient ways to invest. It's a function of time and it's a function of friction. Now, normally when you invest in equities, you have to go through multiple intermediaries, as I mentioned before. And what we're doing as a digital platform is changing that by making sure that with a click of a button, you make the decision for yourself with as minimum interference as possible from the platforms. But the key takeaway is that this future is already here. It's already happening. I think one of the T-shirt earlier, the regular, you can buy these instruments with tokenized versions of the US dollar at this point. That reality is also mapping across to the investment space, when people invest in their assets for their personal financial portfolio. It's mapping into remittances, it's mapping into trade finance, it's mapping into companies using tokenized versions of assets to settle between themselves. Now, there's also the financial engineering component. This is the basics. Now, when you hold tokenized versions of an asset, because it's highly liquid, it's then much more possible to pledge that asset in exchange for participation in other markets as well. So it becomes collateral in your hands, which makes it easier for you to then pledge that collateral in a very transparent manner, in a very price transparent manner, right? An orderly functioning marketplace to be able to take positions in other instruments. Now, this demand is exactly where regulators around the world, and governments around the world have been focused on developing frameworks that encourage innovation while maintaining market confidence. So we saw earlier on the slide, go too fast on regulation and you throttle the markets and participants move on to unregulated platforms, go too slow and the risks build up. And so I think regulators are trying to find that balance, and it's the responsibility of platforms like us, based on our user understanding and global regulatory experience, to support that initiative. Now, we've seen around the world, different countries have taken very different approaches to digital assets and tokenization. There's no single formula that every market follows, but there are some key principles that all regulators globally have adopted. Not just about MiCA earlier, and the Singapore PSA framework and Hong Kong, etc. There are a few things that I want to bring this conversation back to. The first is that to have meaningful regulatory frameworks, it has to be a framework that accommodates players of different sizes, right? So, same risk, same control principles, and I think a legislative framework that accommodates the market participant type makes sense. So an exchange, for example, is very different from a broker or a dealer, and they're very different from a market maker or a hedging venue or a liquidity venue. So the licensing methodology has to accommodate the different roles that market participants play, and the different regulatory capital that we require, the different buffers that we require, and the different kind of compliance programs and processes that we require depending on the function. The second is that there has to be a licensing framework that accommodates the different types of asset classes. And so, as I mentioned before, on the demand side of the equation, there is very strong and clear demand for a broad universe of instruments and services and tools. And if the licensing framework is unnecessarily restrictive in that sense, it will result in users moving towards unregulated platforms. At the same time, I think regulators need to figure out which are the top 5, 10 product categories that matter to users, and then think about regulating them in a sensitive fashion. As I mentioned, a lot of these asset classes already exist in the traditional world, and the tokenization or the blockchain of these asset classes don't materially change the risks. They make them faster, higher velocity, quicker movement across border, but again, the tools to regulate them can be proportionate and commensurate. The principles including technology neutrality are also important. There's only so many jurisdictions in which an exchange can fracture their order book or the liquidity in two before it starts to impact liquidity and price. And so I think there's also recognition by the leading tier 1 jurisdictions around the world that of home jurisdiction, of home regulatory recognition. So for example, if Binance is licensed and supervised and regulated in the Abu Dhabi global markets in the UAE, that other regulators, they come to, for example, from the fact that we have a global order book and a global exchange that's already regulated, and then they regulate us as a broker in the local context. So that's one example of technology neutrality. Also, custody. This is always a common product. So custodizing a core wallet locally versus custodizing the actual technology stack, or rather regulating the actual technology stack are two different things. The the more jurisdictions in which the technology is localized, the more points of compromise or the more opportunities for hacking, etc. So we need to balance the risks introduced to business as a result of regulatory frameworks versus the benefits. So clearly defining ownership rights, issue responsibilities, transfer mechanisms, these are all critical parts of and very common methodologies involved regulatory frameworks. Now, the question is that what can Vietnam draw from these international experiences? Should it take any inspiration from any of them at all? Or should it take its own approach to developing a framework that reflects its own priorities and national ambitions? These are some examples of globally systemically important institutions versus national regulators. The list is pretty long, right? So what do these principles look like? Now, from an international organization, IU point of view, their priorities have been in terms of investor protection, disclosure, custody and market integrity, cross-border risks, financial stability. So depending on the international organization you speak with, they have slightly different priorities. But what we can take inspiration from as a national framework is from markets like Japan, Korea, Australia, Singapore, Hong Kong, obviously. And they all moved at different speeds. So a quick snapshot. While Singapore and Hong Kong moved very aggressively and very pro-business early on, at the moment in the UAE, for example, there is a much broader shift towards innovation, a much more permissive environment. So, as I mentioned earlier, licensing activities and licensing market participants based on their role has been quite instrumental in the growth of this industry in this region. Particularly talking about stablecoins and real-world asset tokenization. On stablecoins, we have the usual benchmarks in terms of NICA. We have the benchmarks. But again, one of the things that we need to bear in mind is what is the purpose of stablecoin in the domestic regulatory framework? Is it merely an on-ramp, off-ramp feature for market participating crypto trading? Or is it actually long-term payment and settlement mechanism, not just for corporate settlement, but also for retail merchant activity? And that, I think, will define the licensing and regulatory framework for stablecoins. In terms of real asset tokenization, going back to my earlier point when I started this keynote speech, it comes back to what is the overarching ambition. A lot of these legal structures already exist. So the starting point, in our view, is to start from how REITs, securitized assets are now regulated in traditional markets, i.e. the securities market, and then map that to a technology-neutral model of blockchain business. The underlying philosophy for us is the same. Innovation should be encouraged, but it should develop alongside strong governance and appropriate safeguards. Vietnam has already made significant progress in establishing foundations for digital asset development. Recent policy initiatives, including the pilot framework for crypto assets, as well as the development of the International Financial Center in Rotterdam and Ho Chi Minh, actually paved the way for a clear commitment to exploring innovation in a structured way. And we welcome this as an organization. What's particularly exciting is that Vietnam is not just regulating new technology, it's actually building trusted market infrastructure more broadly that supports much broader economic development. The tokenization of infrastructure projects that's proposed in Vietnam is one example of how digital finance can connect with real-world needs for global capital, and more broadly, to support investment, improve capital formation, and strengthen